Welcome to Bullshift the podcast. This is the podcast that talks about behavioral finance from the perspective of how the financial services industry shapes your attention and shifts it to make you feel more bullish. My name is John DeGuy. I'm the author of the book Bullshift and the host of the podcast. My guest this week is Gillian Kunza. Gillian is the co-founder and CEO of Designed Securities Limited. There, she focuses on optimizing the firm's organizational strategy. Designed is Canada's first firm to be dual registered for both mutual funds and securities, and she holds a business administration degree from Trent University, a chartered professional accounting designation, and she recently completed an executive MBA from the Rotman School of Management at U of T. Welcome.
Hi, John. Really happy to be here.
I'm wondering if you could begin by telling me how you got into the business of finance.
Yeah. I had a bit of a zigzag path coming out of school. I thought I would be completely in the world of accounting, working at one of the big firms, doing audits and proceeding with tax expertise and really focused on that. And instead, I did do some work for a few accounting firms, taxation, estates, and all of that. But at the same time, I ended up doing accounting work for an investment dealer and sort of dig my way over into the finance side of investments and what was really happening at investment dealers, but also with clients, because
Mhm.
it ended up sort of bouncing back and forth between what I would do as an accountant, but the fact that lots of clients also needed tax advice or different things generated, and I ended up being a bit of a resource. And over time, I was splitting my time going back and forth between, the career of a true accountant versus the career of accounting, maybe within the world of investing, at the dealer level and at the client level to a degree. And eventually I had to pick because volumes only allow you to get through so much in a day. And I thought I'm going to stick with the investment side of things and sort of more the corporate head office as opposed to directly dealing with clients in accounting. And from there, I was part of the evolution of a small family business that got they're bought out by some additional partners and continued to grow. And I stuck with that company for some time and did operational roles and compliance roles. I was part of the executive team and had a good career and a good chance to sort of move out of accounting and into other traditional roles within the investment world. So I got great experience, sort of ground floor building up from a lot of different perspectives until, I guess until my position now, where in the last couple of years, I have co-founded Designed Securities with my business partner, Michael Konopasky, and we had everything we needed. We had all the experience to look at things from those various perspectives and really put together what we thought was a compelling plan, compelling strategy. And yeah, it's been an interesting career path, and it's worked out well. And I never would have imagined that I'd be here, but I don't think
Here
anyone
we are.
ever knows where they're gonna be. Yeah.
It's fascinating how so many people who work in finance didn't imagine themselves working in finance before they got into finance. There are just a lot of people, I was doing a graduate work in public policy and public administration before I ended up in finance. It's very odd that, people like, accounting and different fields can end up in finance. You mentioned Mike Konopasky, he's already been a guest on the podcast, as you know.
Yeah.
And you and he talk a great deal about independence, which is something that's near and dear to me personally as well, because I write about it all the time. So, what do you mean when you say that Design Securities and its advisors are, quote, independent, unquote?
Mhm. Yeah, it's a great word, but I think too often it's used as a buzzword or it's catchy or it's just used so commonly that it gets thrown into the titles or the mix or the name or whatever it is. And we sat back and we said, no, there is a real definition to us of what independence means. And it has a lot of perspectives. So one are things like conflicts of interest. So our
Mhm.
belief is that if you're a public company or you're ultimately accountable to shareholder base of who knows who's holding your shares, but if you're accountable to them, how can you serve two masters? You can't, right? So the dealers then conflicted and the advisors not in a space where they can act truly independently, because at the end of the day, They are there to support the shareholders, not to support their clients. So we see that as a problem. Uh, we see proprietary products. I think that's a more simple one to understand. But if you've got proprietary products, even though you might not have quotas or require your advisors to use them, you you can't totally be an independent advisor if you're in an environment that has that conflict sort of as a foundational piece of the dealer's business. Of course, they're motivated to have you use their funds and their products, and perhaps some of them are really excellent and they are the right choice for your clients, but not all of them. And I think there's some pressures there subconsciously, consciously, who knows, but that to me is not independence when an advisor's got an agenda of another sort of business line that could easily influence advisors. We also see things like dealer preferences as sort of prohibitive on an advisor's independence. So there are rules to follow and guidance that we all follow within the industry. And then there are dealers that have preferences or that say to advisors, well, you can't do this and that's a rule. But it really isn't. It's not a rule. It's the dealer's rule that they've come up with for various reasons. But
Mhm.
it's it's important to look at what you want to handle as a business, but to leave advisors in a space where they can operate independently, you can't sort of layer in this extra layer of rules or things that your firm does, and sort of position that over top of all advisors. Sure, there are rules or certain guidance or things you might need to do for individual advisors because practices are unique and different, just the way that clients have unique situations that advisors have to accommodate. But an advisor doesn't take one client's situation and then tell all other clients that now they're limited,
Right.
right? And I think that's what we see happen with dealer preferences. They've got something they've decided that they're going to do for everyone, even though it's really not necessary. I think lastly, for independence, communication is a big miss uh,
Mm.
in lots of ways, but I think for a dealer to really claim independence, they have to be open to the feedback and the conversations that advisors want to have with them. Doesn't always mean a change of outcome or something can happen, but John, you and I have had plenty of conversations just sort of talking generically or high level about could be compliance or what we
Right.
think about this or what we think about that. And that's an open dialogue that I think helps support your independence. You know, you have some place you can turn and talk to and understand what we're doing and what's motivating us or why we made certain decisions. And we try really hard to have that channel open. And I think if you don't have that, you have nowhere to turn and you can't get answers when you're trying to operate independently, it's also hard because you don't know the factors that are sort of happening in the curtains behind the scenes that are very critical to the systems and the service and the platform that you have to operate in as an advisor. So a lot of angles of independence sort of hit me when I think about what that really means to us. And I don't see that being how other participants in the industry see independence. I think there's sort of a generic use of the word, but if
Mhm.
you really ask someone to say, well, define it, and if that's your definition, are you using it correctly?
It's funny you should say that because one of the first things I do whenever I'm having a discussion with someone about, well, what is independence, the first place I go is to a dictionary. And if you look up the definition in a dictionary, it
Hmm.
says that you're free of any kind of external inputs and you're free to
Yep.
do as you see fit. And there are lots of firms that say they're independent, but then they take that that free hand to make decisions away from advisors. The way I would portray it is about a century ago, Henry Ford used to tell people you could have any color car you want as long as it's black. There are advisory firms who would say you can have any viewpoint you want as long as we share it.
Yeah.
And that's the way the industry. My experience is that when firms say they're independent, what they just mean is they're not owned by a bank, and that's the extent of their definition. It's an extremely narrow,
Yeah.
self-serving, industry-specific definition that would never pass a generic. If you ask a man or woman on the street, what does it mean to be independent? They would give you a very, very different definition. All right, enough about that.
Yeah.
Let's move on. Let's move on to some changes that took place in 2023. Regulations changed last year. And so to begin, there we have a new self-regulatory organization, IROC, the Investment Industry Regulatory Organization of Canada, and the MFDA, the Mutual Fund Dealers Association of Canada, merged into one new organization called CIRO, which is the Canadian Investment Regulatory Organization.
Hmm.
Perhaps you could Walk us through what that change in regulation, which is now almost 15 months old, means. What does it entail for investors in particular?
Yeah, I think it is a large change, but for what people have felt so far, I think it's fairly minor if you
Mhm.
trickle down to the client level. I think step one was between the MFDA and IROC, they just had to agree on, are we doing this? And that's the step that finally got taken. They said, yep, we're doing it. So let's come up with our sort of new infrastructure, a new name. Let's formalize it. Let's get the votes and approve it and seal the deal. And then let's start the work. So I think it's a good thing to evolve the industry. If you look back, I can't even remember how many years ago it was, but the accounting profession went through something very similar. There used to be certified general accountants, CMAs, CPAs, CAs, or sort of a group of about three different bodies, and they did all come together under one. And it has united the profession and provided certain advantages and just a better way to look at the future. And the investment industry is now doing the same thing. So I think it's a really positive thing, but I've seen this sort of transpire in another industry, and it takes a lot of time to get there and eventually sort of land in a spot where the old world is in fact closed up. But that's not the case because right now there are only, I think, about 8 firms that ultimately are dual registered. Our firm was the first, as you mentioned. Uh, but there are several other firms that they're still operating as mutual fund dealers only or full securities brokerages only. And not a lot has changed for them. They've sort of said, let's just see how some of this goes, and then we'll decide. So if you look at those clients, there has been no change at all. If you look at our clients, the extent of the change has been fairly limited, maybe a name change or maybe sort of something in a disclaimer, but it really hasn't changed the client's experience with our advisors because it just doesn't have that type of weight in terms of trickling down yet. But there could be, right? And my hope is what the clients feel are positive in terms of either new options opening up or something more simple for them to understand. I don't know exactly what it will be. I think advisors being the more knowledgeable of the two between clients and advisors have a much closer relationship with their dealer. My hope is that they would see some of the changes and understand them more, and maybe that's going to change their business, and maybe it's not. Who knows? But I don't think a lot of change has really happened yet at the client level.
Okay, so the one thing that I think has changed is at the regulatory level is in January of last year, something called the client focused reforms,
Hmm.
CFR, were enacted, and specifically in terms of the way accounts are opened and then regulated and monitored on an ongoing basis. There's now a dual test with regard to risk tolerance and risk capacity. Do you think that has any kind of an impact? And if so, what might that be?
Yeah, I like this question because depends what lens you put over it. But
Mhm,
if I sort of take a certain stance, I can really argue that it's not new at all.
mhm,
If I think of what advisors have been doing for decades,
mhm,
you've sat with clients and you've certainly made assessments of what is your income? How much savings do you have? What is your cash flow? And those are very much part of that dual looking at the client's risk capacity. And simultaneously, you've been having conversations to get to know the client. What are their attitudes, beliefs? How do they feel when you say, hey, what would be your reaction if you lost 10% or 20? So that's your assessment of, what's the client's tolerance to sort of handle from an attitude standpoint risk. So that assessment of capacity and tolerance has sort of always been there, but it's been more in the advisor's hands to have those conversations, shape them with the clients, explain them the way that they believe their clients will understand them. Certainly, a lot of advisors have particular client bases that they deal with or niche
mhm,
clients, or who knows, it's different for every advisor, but it does create a difference in how one advisor may interact or try to explain and educate their clients. Not all clients are the same, so the education sometimes isn't the same either. So I think what's happened is the regulators have said that's that's too far away for us to understand and know what you're doing. Uh, do they believe you're doing it or not doing it? Yes, it depends which regulator you talk to. But I think what they were looking for was something that they could say, we need to see where that conversation is landing that actually ultimately gets you to a point where you're doing these percentage allocations for a client
Right.
in sort of a low or a high or a medium high risk tolerance. Like where are you, or profile, I guess now would be the better word to use. The overall profile has this sort of ranking of what would be the client's profile. And that's derived from looking at all these underlying factors. But while the advisor has been having those conversations, the regulators don't see it. They just see
Right.
this ranking. And they're really trying to use client focused reforms as a way to say it's not enough. Advisors aren't documenting it enough. We can't see it enough. It's not transparent to us. Doesn't mean the advisors aren't doing it. And then you've got dealers sort of sitting in the middle going, okay, we have this rule that is uh, subject to sort of a certain application that we get to decide, but we have to appease what the regulators are looking for while simultaneously not creating something so rigid for advisors that what we do is we change something that's actually not even new. It's something they're
Mhm.
already doing. But if we impose this way that we're going to do it in such a way that now you're going, well, geez, that's not how I've been having this conversation with my
Mhm.
clients. You've
Mhm.
really thrown a wrench into it. It's going to create client confusion. It's going to be problematic because you're trying to marry in what you've done for years with some change the regulators have made from a formatting standpoint because it really
Right.
didn't change the rule. So these types of changes are, I think it's good to go through reviews and have things like client focused reforms or whatever you want to call it. I think the industry itself changes from a product standpoint and account type, and there are things that merit a re-review of rules and guidance. But it's a funny balance between creating a new rule or an infrastructure, having client focused reforms come out, and trying not to confuse the public to say, well, we're making all these changes because people weren't doing it before, because that's not the truth.
That's right. Okay, so a couple of weeks ago, I had a guest named Lauren Jeffrey on, and Lauren talked a little bit about how she will try to drill more deeply into understanding tolerance and capacity. And then the week after that, I had Sean Brayman, who is one of the real experts in risk profiling questionnaires. And
Hmm.
Sean's of the view that the questionnaires are virtually useless because they're so malleable and not necessarily repeatable. So even though people have been doing it forever, as you say, and I agree with you about that, my concern is more along the lines of what Sean talks about, and the dual mandate of risk tolerance and risk capacity is what Cyril was saying is that when in doubt, if one is a 6 out of 10 and one is an 8 out of 10, you need to build a portfolio in favor of the more conservative of the two. So you should
Yeah,
err on the side of conservatism, and that strikes me as being perhaps a little bit new, maybe nuanced, but nonetheless, I think new. Uh, my deepest concern, candidly, and this is me speaking personally, is
yeah,
that a lot of people don't really know what their risk tolerance and capacity is. And specifically, if you're a retiree, your capacity could be significantly reduced because you're no longer able to earn money to buy the dip, because whether the dip is small or large and whether it's short lived or long lived, the fact of the matter is you're not earning more money and you can't go back and buy that dip. And that all ties into my concern about optimism bias. I view
hmm,
I think to be responsible, you need to be careful and err on the side of caution, which is what I think the client focused reforms are asking advisors to do. All else being equal, the tie goes to the more conservative
yeah,
outlook. But historically, my experience has been that in baseball, they say a tie goes to the runner. Historically, in finance, when you can make the case for a portfolio that might be a 60-40 and it might be a 70-30, advisors and the firms that they work with will say, "Oh, we can handle a little more risk," and they'll err on the side of being slightly more aggressive, and they'll have 70% in equity and 30% in income. It's
yeah,
on the margin. I'm not suggesting it's massive, but I do think that on the margin, the new admonition, the new mandate is to be slightly more conservative than might have been the case previously. That's my interpretation, but I'm not a compliance officer. I'm curious what you think as a CEO.
I would have to agree with that uh, with that statement in terms of when you look at it from disconnecting capacity from tolerance and making a larger, more clear statement as a regulator that when they're not the same, you
Mhm,
take the lower of the two. Because that
mhm,
hasn't really been clear if it was there before. It might be sort of part of guidance or but I think in the past, traditionally, people have sort of meld the two together and sort of created this average
mhm.
profile, as opposed to saying, okay, well, if one of them's lower, we can't mold them together. We really have to constrict to the lower one. So I do think there is a leaning towards a more conservative uh, approach when you look at it from that particular rule change. I think the crazy part of the industry is really how subjective all of this is.
Mhm.
Like if you look
Mhm.
across the country at the number of investment dealers, mutual fund dealers, portfolio management firms, all the firms out there, and you compared how they view risk, what bandwidth do they use for their tiers, how do they measure their products or this and that, you could give the same client all of them and end up with hundreds of different outcomes. Arguably, lots of them would be within a suitable range or something
Mhm.
realistic and valuable for the client. But if you go from the client perspective and you think, well, if I go from this firm to this firm and nothing in my life has changed other than the firm that I'm using to service my financial goals, shouldn't things stay the same for me?
Right.
And that's not really the experience that can happen. A client could simply have no changes in life, move over, and at the new place, their investments could be offside or not suitable.
Mm.
Or all of a sudden, they could have a whole other range of clients that are or products, sorry, that are open to them. And none of it's technically wrong.
Right.
It can be, uh, but that's why I think the role of an advisor is so important, and it's not necessarily about which advisor is going to help you make the most money. I think the more important role is the advisor as the financial psychologist and really helping a client, bear the market when it goes wrong or not get swayed by the flashy, exciting things go on, or just have someone that's saying, let's make you accountable for some savings. Because without that role, a lot of people just don't really know what to do or how to interpret things or where to go for advice. So it's not. I think the optimism sometimes is is problematic, as we've seen. There've been events in the past that everyone thought they were suitable and fine, and then some significant event happens, and all of a sudden you think, well, those mutual funds didn't really
Yeah.
go the way that I thought they would, and they don't look all that suitable anymore. But it doesn't it depends what client and what dealer and what advisor and what are all the subjective things around it. Was it right? Was it wrong? Or was it just the circumstances? But yeah, interesting field of work to be in where as you move around between companies and people and clients and advisors, the layers of subjective understandings is just
And
massive.
I think people don't, as you say, it's so subjective. So a lot of people don't even know themselves, if you're an investor, what your
Yeah,
tolerance and risk profile is, unless and until you have to go through something in the form of a severe downturn. The questions are pretty much entirely hypothetical. You don't even
yeah,
necessarily have a life experience. And if you think that enduring a 33% downturn during COVID, which lasted 5 weeks, and then the market hit a bottom and started coming back up. If you think your ability to withstand that because you're a long-term investor is something that constitutes long-term, brother, I've got news for you. 5 weeks is not long term. It's a drop in the bucket. So it's the Mike Tyson used to have the phrase, "Everyone has a plan until I punch them in the face." Everyone says they can tolerate risk until they have
yeah,
to endure a major downturn. And the concern that I'm having is that I don't think I think there's a certain amount of recency bias in terms of what happened with COVID in
yeah,
February, March of 2020. And I think we're at the point now where people are starting to forget about the lessons that we should have learned during the global financial crisis of 2007 to 2009.
Yeah.
And a lot
Yeah.
of people are whistling past the graveyard, and they think, oh well, central banks have our backs, and if things start going sideways, well, don't worry, our friendly central banker will lower rates to zero. And if what happened in COVID is any indication, we might even have the government sending us some checks, and everything will be fine. And I really don't think anything like that is likely to happen next time around. But a lot of people have become complacent, and I worry
Yeah.
about that. And I don't know what to say other than I think a lot of people are being optimistic to the point of being uh, jingoistic about the industry, and naive and dangerously rose looking at things through rose-colored glasses in terms of what the future might hold. And all I can do is express the concern. It's out there. It's a
Yeah.
thesis that's been out there for a while, and it's funny because with me, on the one hand, I don't want markets to drop because, like anyone else, I want people to meet their financial goals and so forth. Conversely, I'm concerned that people won't be ready, and although I don't want people to have to go through hardship, the only way to test the thesis of people aren't ready is if there's hardship, and then we'll
Something.
see whether or
Yeah.
not people are ready. And so I am both eager and trepidatious with regard to whenever a downturn comes, because I don't know how people will be able to do that. I guess maybe I should ask you, do you think advisors are doing a good job in helping set realistic return expectations for their clients, without using numbers? I'm not going to ask you to use numbers. Just in general,
Yeah.
you think people have reasonable expectations about what kinds of returns they might experience over the remainder of their investing lifetimes?
I do. I I think I wouldn't be in the position and I wouldn't be sort of here trying to push forward a piece of this industry from from what I can contribute if I didn't believe that the advisors that I got to work with and that we are,
Mhm.
building out as part of our firm weren't doing a reasonable job at that. I think,
Okay.
unless you're part of the conversation, you never know. But I also hope and do believe advisors are trying to have a more broad conversation that isn't just about the numbers. I know that's a critical part to talk about. If you're saving for a certain period of time or an outcome or your retirement or whatever, yeah, you have to talk about returns and risk reward and all of that is part of it. But without landing in a place where the client leaves and thinks, okay, I need 8% and that's it. Like then
Right.
that's all they're thinking about, right? Because then those expectations can't be met unless of course there's a perfect 8% linear track
Right.
line, which it will not be. So I think advisors really need to focus on the fact that financial success and achieving your goals is not a linear path. Um, so that's where the expectation. I hope those conversations, and I do believe that they're going well. I was going to make a point earlier too that one of the other interesting components of the puzzle, or even optimism bias, and sort of testing theories and whatnot, is this uh, categorizing of time horizons, which again,
Mhm.
across firms,
Yeah.
it's like what's the difference between 1 to 3 years and then 1 to 5?
Right.
And in a year, there can be significant changes in a client's life, or in 4 years,
Mhm.
that it depends. But you're signing off on this position of here's what I think my tolerance is as a client with a time horizon of 10 years. Like it's unlikely that in 10 years you're still going to have the same profile. So why is it that anyone's being asked to sign off on this is my
Right.
plan for 10 years? I mean, I see the pros of it, but like I could argue it either way. But time horizon is another interesting one that when you layer it into things like capacity and tolerance, and then you look at just the concept of looking at a time horizon, you don't know when you're going to have a hardship, whether that's industry driven or
Right.
something individual
Personal.
in your life. And you know understanding your risk profile as an individual uh, you'd have to reassess it lots of times and be quite educated and really and have a nice looking glass to know, oh, that's what's going to happen to me in 2 years. So if that's going to happen, then today this is what my risk
Right.
profile should be set at. But you can't
You
do
can't do
that.
that.
So you sort of wonder how Time Horizon has this uh, looking glass approach to it, and you just sort of had to guess that, well, here's the intention. If
Right.
everything stays as is, I could go 10 years like this. But even if
I don't
everything
know.
stays as is, it doesn't necessarily mean 10 years is the right time horizon or
A lot
11
of
years or
Yeah,
or
exactly.
7. Like what's the difference? It should sort of just say, look, do you need the money in the next year? And if not, it's above a year and then just
Sure.
call it a day. But who knows?
Behavioral coaching is a funny thing because a lot of what we're talking about now, implicitly is, the advisor's ability to navigate, to assist a client in navigating those life
Mhm.
events, and life events including market events. So they can be both micro and macro. And my concern is that I think advisors do good work directionally, but I think they might be overstating the impact they can have, because a lot of people, first off, nobody can foresee, a divorce, or
Yeah.
cancer diagnosis, or what have you. But even beyond that, given what I said earlier, a lot of people don't really know how they would react if there was going to be a market downturn, especially if you don't know how deep it's going to be or how long it's going to last. So there's a lot of stuff.
Yeah.
Advisors can do a lot of good work, but there are limits to what they can do, and you don't want to overstate those impacts, because it's difficult. Then you have to be accountable for, well, you said you could do this, and realistically, no one can. So, all right, let's see if we
Yeah.
can wrap up here. I always like to finish with two things, and the first is, that's bullshit. Jillian, if it was up to you, what would you change in the way the financial services industry works?
I did think about this one. You did tell me in advance you might throw this at me, so I had a chance to think about it. And the thing that came to mind, and I kept coming back to, was or is transparency.
Mhm.
I think when you look at regulation and how it's changed, certainly some of it we understand, but I find all too often I can't identify the problem that they are trying to solve. I don't know how they came to the conclusion that client focused reforms was the solution to XYZ. Uh, I think with dealers and the way dealers have freedoms to operate a certain way, I think dealers need to be very transparent and say, here's what we're doing and here's what the rules are. But you know what? We're adding another one, and just be very
Mhm.
transparent about why and what that means for advisors. Because at the end of the day, this industry is built on trust.
Mhm.
That is what you are doing with your clients. You're building trust. And if you're only giving your clients half the picture or only some of the information they need, and it's not a transparent relationship, that trust, it will erode or it won't be strong enough to really sustain when the clients need you the most. And
Good.
I think so much of that transparency is lacking throughout the industry.
Okay, so from there we can move to shift habits. If it was up to you, and there's this problem about transparency, and what is the problem that you're trying to solve, what
Hmm.
prescription would you offer to solve it? How would you alleviate the concern that you just raised?
Well, we could throw more rules at it, requirements. Well, I think one is leading by example. That only gets so far, but I do believe that in the decision making and the way our firm is operating, transparency is extremely high on the list. We feel we don't have anything to hide. This is sort of an open forum. If you have questions, you come to us and we will have an open dialogue. If you are trying to do something or work on something with a client, turn to us. This is hopefully a very transparent dealer in the way we operate, and people see that, and there are great benefits. There's no disadvantage to us. I think it's all for the better for everybody, including the relationship we have with our regulators. We're very open and transparent with them, going to them and saying, "Hey, this is what came up. This is what we're thinking of doing. Is that what you guys would, do as well, or how do you see this?" So there's no sort of hiding and saying, "Well, let's do it this way and hope that no one sees it, or we'll just sort of spin it around and sell it this way." We just don't engage in that type of behavior because it doesn't fly for our values
Perfect.
and beliefs. How do you prescribe or get that to be more pervasive in the rest of the industry? That's a tough one. I mean, transparency is really hard to go back and fix.
Mhm.
Uh, Transparency is something like trust, you build over time. You say, here's something we're going to show you to demonstrate our transparency, and then it's a pattern of behavior or pattern of decisions where you continue to put the full picture forward, and people start to see over time the transparency. Whereas going out and saying, effective immediately, this is happening, or
Right.
here's this rule. This rule now requires that you file some document that's going to help highlight things in a more transparent way. Sure, you can do that, but that's sort of superficial.
Right.
So I think I would love to see more transparency just in the small actions that are taken,
Mm.
uh, the slow moving change to do it that way, but it's the more honest way of doing it in terms of building a long term transparent model of business. But
Perfect.
hey, if rules come in and require certain disclosures or more of this or less of that, then it sort of opens the gates so that people have a more clear picture of what's actually happening in the advisor's world, in the dealer world, in the client world. We could all sort of look at each other with a bit more understanding and really, I think, ultimately have better investor outcomes, not necessarily in dollars and cents, but in experience and in what this industry can really provide and do.
Perfect.
Yeah.
Thank you so much. That's a really fulsome answer, actually more fulsome than I expected. So that's great.
Oh,
Jillian, I want to thank you for your time today. It
thank you.
was wonderful. I want to wish you all the best in all your endeavors going forward. And I'm sure we'll be talking soon.
Likewise, John. Thanks so much.
John DeGooey is a portfolio manager in Toronto and the author of the book Bullshift: How Optimism Bias Threatens Your Finances. Bullshift is available online and in bookstores everywhere. The opinions expressed in this podcast should not be construed as investment advice. Bullshift, the podcast, is produced by TalkShoe, a division of IOTM.